Good afternoon, everybody, or morning if that's when you're listening to this. Welcome to the latest episode of the ASX Small Cap Wrap. I'm here with Luke Winchester today, the CIO and founder of Merriweather Capital that has the Merriweather Inception Fund. Luke, thanks for being here.
Thanks for having me back on, mate. I got great feedback from the last time I was on. Had a couple of really nice emails come back from a couple of, I assume they were supporters, but said they got a lot of value out of it, and a lot of people, like some in-depth coverage on small caps, which is pretty hard to find nowadays.
Yes, and I've heard the same thing. So, I realize it's a bit of a niche audience, but the nice bit of feedback I got recently was keep doing the deep dives into the small caps, and that is my concept, right? Because that is where not that much content exists, really. Because you have to have a bit of a nerd hobby to be wanting to look at these little companies that are really under the radar and too small for some professional fund managers. Although there are a rare breed who I hope to have on this show that do look at those little companies. So before we get into the show, of course, I have to do the ritualistic disclosure thing. Essentially, the way it works is I'm not intending to give advice in this show. This is just bits and bobs, sharing our research, trying to share our journey and the lessons we've learned as small cap investors. Of course, it's actually the law that defines what is advice. So any opinions that would be defined as advice under the law, they are authorized by myself, Claude Walker, authorized rep of AFSL 276544. You can look in the show notes for the full details, and also I'll have it up on the screen on the YouTube version. And so with that out of the way, I should also give a proper introduction to Luke because, of course, me and him, we used to do a lot of Ausbiz together. I know Luke's still on Ausbiz, and we've had so much fun over the years growing as investors. And I guess these days, Luke is a fund manager, but he's also one of my fund managers. So I should disclose, I have a small personal investment and then also a more significant SMSF investment with Luke's fund. So obviously that's just once bought in and I've never sold out. So I'm not trading that in any way, but I guess I also put my money where my mouth is when I say that I think Luke knows what he's doing. Luke, do you want to tell us a little bit about, I guess, your journey as fund manager so far? A few years ago you started.
Yeah, well, as you sort of said, been doing it personally for a while. Micro caps, it's a small community and sort of been involved, similar to yourself, for sort of a decade or so. But as far as professionally, running the own fund, we launched Merriweather in mid 2021. But by the time we actually got the fund up and off the ground, it was November 21, which might ring a bell in some people's memories because it was basically the top of the market back then. And yeah, it was a tough start, obviously, to launch a fund. But I got some really good advice from people, back when I launched the fund. And the main thing I heard from a lot of fund managers, especially boutique fund managers who were sort of starting off small and starting off their own, along the lines of you'll get the investors you deserve. So if you sort of chase investors who are only there for short-term performance or only there for
momentum,
the momentum, good times going up, that money's going to leave you very quickly. But if you're open, honest with your investors, you stick to a long-term strategy, those people are going to stick by you. And that's what we've had. I won't say every investor's stayed in the fund, but the vast majority have. Many have topped up. But more than anything, and yourself included, just lots of support from investors and people in the industry. The funds, we've recovered okay. Had very much had a tough sort of first year in particular in 2022, like a lot of micro small cap funds and investors.
I did as well. I had a tough year that year, and that's just the nature of it. If you're going to do a strategy that's high risk, it could potentially get bigger returns over the long term, but it's going to be more volatile along the way in most scenarios. Mostly if someone tells you, I can give you a high return with less volatility, mostly that is not right. Mostly that's actually depending if that can be an extreme claim. If it's high, guaranteed 8% returns, you basically just know it's dodgy if it's claiming so much more than the true risk-free rate, and it's also risk-free. So obviously no one thinks the microcap fund is risk-free. I certainly don't. But also, I say that the microcap fund managers, they do earn their fees, because I just the absolute stuff you see at the microcap end of the market is just the most enraging stuff as an investor. You see the real blow ups, you still the real tough situations where it's like could even go bankrupt, or there's some terrible outcome. And yeah, and the governance can be a lot worse as well. In fact, that's probably a good segue into the first stock, Prophecy International. That's ASX ticker PRO. And I chose this one because it just seemed right to actually have a chat with a good friend of mine about a microcap software stock that both of us got sucked into at different times. And I guess I wanted to offer it out there. If you're going to do microcap investing, you need to hear about how people lose money, because it's going to happen to you as well. If you do microcap investing, if you do small cap
100%.
investing, you're going to lose money. So, Charlie Munger had the old saying, which I think is one of his best quips of all his prolific collection of quips. I think it's tell me where I'm going to die so I don't go there, which is like the way of saying let's talk about the bad outcomes and how we got there. Let's understand that so we can avoid it. And
Yep, 100%.
so that is a pretty brutal introduction to Prophecy International. I'm going to put the chart up on the long-term share price chart. This thing has been listed for years, since 1998 actually. Had a massive spike into 2000, down nowhere. Another spike in 2015, and then another more recent spike in 2021. But there it sits at 23 cents all these years later. Luke, can you give us a little bit of rundown, I guess, of what Prophecy does nowadays? Because in that whole story, it's had a few twists and changes. But what's the company do today?
Yeah, a long, winding corporate history, but in a nutshell, it was a bit of a holding company for various software assets. But sort of what got me interested a few years ago, they had refocused the business onto two key assets. One named Snare, which is in the cybersecurity space, and one named eMight, which was in sort of contact center data analytics, sort of that broader space. Look, and this was a business for me anyway. I'll sort of go through the experience that I had and we had with Merriweather. It was a business that I thought was a familiar investment setup, which is a software business going from a traditional license-based revenue system to the subscription. And so, when you have that transition, and we've seen a few businesses go through it, it can create opportunities because the numbers can get a little bit ugly as that transition happens. But underneath that, the business is building a nice recurring base of revenue and that long tail that will stick through. So that was always a thesis with Prophecy, was that sort of I was looking through, without mincing words, what were some ugly reported numbers, some reported operating losses, because they were generating good cash and they were generating good growth in that annual recurring revenue. And so that was the key thesis. It was in place for a while, but there were a few orange flags along the way. And when you sort of own a stock or you got conviction, you can maybe hand wave them away a little bit, or sort of talk yourself into reasons to stay bullish. But in the end, a few weeks ago, or a couple of months ago now, there were just some glaring, those orange flags turned into glaring red flags, and the business potentially looks in quite a difficult position at the minute. So, as I said before, the thesis was that growing ARR, good cash flow, and that's all evaporated to the point where, their ARR went backwards by nearly 20% on the loss of a key customer. To that,
when there's a loss of a key customer, there's always like a few gray areas. Like you might be able to get them back if there's still a discussion going on, or alternatively, like, is it material? Like you could say maybe in a percentage term it might not be, but for a company, when that makes a difference between growing and not growing in that specific circumstance, obviously it's going to be meaningful to investors. So that strongly negative free cash burn, I guess now of 6.2 million, even worse, what is about 7 million almost, or 6.6.5 million. That's big cash burn for a company with less than 5 million. So this is the exact kind of situation now where if you've still got the stock now. So actually, can I ask you, when did you sell roughly in this latest?
The day of that merger announcement.
Yeah, right.
Yep. So again, this ties into a little bit of my issue with the governance. I'm sure there's probably a recording of the call that they did, but they did a management call announcing that.
Yeah, right.
That potential merger. And as part of the slides, they disclosed that Prophecy's ARR had declined from rough numbers 25 mil to 20, 21
Oh,
mil.
wow.
And it wasn't until I asked a question in the Q&A, and I asked the question, why did ARR decline, that the answer was we'd lost a key customer. And again, I just thought it's a little bit disrespectful to shareholders, to be honest. I mean, we're investing in a software business. As you said before, as software investors, you can stomach operating losses to a certain degree if the business is growing, if it's building that recurring revenue base. And so when a key metric like ARR goes backwards like that, I mean, it should be announced straight away, like as soon as,
Yeah,
as
it's a
soon as
big surprise
it's
to the
known.
market, isn't it?
And then sort of really sort of outlined to investors as to what had happened and whatnot, because it's valuation multiples in software, like it or not, are based largely on ARR multiples nowadays. So it's a key input to people's valuation multiples, and it's a key input to how people would look at the stock. So that's the day we sold. Yeah.
24. Wow. See, I was still
Yeah,
languishing
and
on
sorry,
like
it's
18.
22 million, so it was 25 back to 22, so they lost about $3 million in ARR.
There you go. Okay, now I've got that one. I can put that right up there. It's better off to just, if the thesis is broken, you do have to have a thesis, a set of
100%.
expectations, and you're better off taking that capital and having another shot with it. Yeah. So like, even if you've lost half of it, like, well, at least you're still, if you get a double, you'll be back to where you were. But it can happen when you can get doubles and stuff like that if you pick a good one. So you're much better off actually trying again rather than staying in a company after the business is broke. Like the thesis that you had for investing is broken. It could go up, it could go down. But one thing for sure is like, just also psychologically, like if your thesis is broken, I think you're just better off getting out of it. And then, hey, you can always buy back in if you're like, forget my thesis. Now there's a new thesis that's attracting me to the stock. Fair enough. But yeah, overall, I think that it's right to sell. And also the heuristic that I used that kept me out of Prophecy was basically just, I couldn't see the signs that the products were like that good, particularly good. And I think that that's like now come out in the fact that their retention's not very good.
I agree.
But I think, in software investing, especially small cap software investing, going out and figuring out, whether the actual product is good, is something, that can really add to your analysis essentially. And that can be as simple as like trying to find people talking about it on Reddit or whatever. I remember what eventually convinced me to buy and recommend Altium shares, which has now been taken over, by the way. But it was previously a recommendation of A Rich Life, and also own shares myself. The thing that finally convinced me is just there was so much content, user-generated content on Reddit and every other forum talking about using it. And
the main issue with eMight was most call centers, particularly cloud-based call centers, they're hosted on larger companies' infrastructure. The main two being Genesis, Amazon Web Services, TalkDesk. There's a few out there. So eMight, it was never a standalone software product. It was sort of that sort of overlay on another, larger software system. And so the issue was always, well, you're a data analytics overlay. These software systems come with their own.
Yeah.
Now, that might only be a rudimentary sort of product, and there's obviously value add there. But I think you're right. I think for me, I always like to, look at what sort of customers are you winning. And look, to be fair to them, they were winning some big enterprise customers, but it's clear, particularly, they've had some churn. Obviously, their largest customer, and there's probably been some others as well. But I now agree with you. I think it's pretty clear that the product.
It sounds like
it might have at a point in time might have worked for these customers. And it was that COVID period where all of a sudden everyone had to be virtual. Call centers, had to go from being in person to virtual, and maybe that's where Prophecy had their sort of time in the limelight. But as things have progressed, I suspect you're right that the software probably didn't add as much value as what I thought.
But now there's a narrative change, and I'm excited for you to tell us all about it. But the company I'm talking about is xReality Group. The ticker is XRG, and it used to be known as indoor skydiving. Australia, I thought something. What is? Do you remember what the
Yeah,
old ticker
yeah,
was?
yeah. Indoor skydiving Australia, because they licensed their indoor skydiving technology from a US company. So that I think they had to
Hmm.
make that distinction. They were the Australian group.
Yeah,
I think
it's only
so.
made
I
it
mean,
statutory profit once in like the entire 10 years.
yeah, and
So
even
yeah,
that probably could have been a revaluation or
any
something like
ladies
that.
and gentlemen, this is exactly why I do outsource investing to Luke and other people like the DMX guys, because I just can't bring myself to look through these like detritus companies with 10 years of losses and stuff like that. So with that, the hardest possible intro to come back from Luke. Tell us the new story.
Well, look, I don't disagree with a lot of the old story. It's really hard because I'm the same as you. Like, I've been doing this for so long, and you see these companies, and you see these people, and you see these ideas, and these brokers, and the people on the top 20 registers, and you get this long memory that builds up, and you sort of spot them all a mile away. And it's sometimes hard because you do genuinely get turnarounds every now and then, and not saying xReality Group is, but potentially could be. And so it's sometimes hard to know, when do I fall back to that, essentially that gut feeling you get when, oh, this is just another one of those. I've seen this story before a million times. The same people are still here. The same CEO, same board members. There's been a couple of, like, the non-execs have changed a bit, but the key people are still here behind this business. So it's like, how do you go from indoor skydiving wind tunnels to what they're doing today is a virtual reality training product for military and law enforcement? So,
Yeah,
you know, for lack of a better description, putting on meta meta VR goggles, and also some sensor
I'm
tags
gonna I'm
onto
gonna
onto
put some sweet images of it.
yeah, put some images in, some
Yeah.
sensor tags on people and weapons, and to anyone who's ever done a virtual reality session, you're doing that, but in a simulated combat environment, or a law enforcement hostage situation, whatever sort of gets put in, and it seems like this weird leap. Well, how do you go from there to there? The founders of the business, and they've been heavily invested this whole time for about 10, I think it was listed back in 2013, so 12 years. Bought decent stock on market, to be fair to them as well. But they are former SAS military, Australian Defence Force people. And the indoor skydive, was more built out of that defence background rather than the consumer, people for leisure showing up in school holidays and just going for an indoor skydive.
So did they
Um,
have like defense training and stuff as a
yeah,
customer? The
yeah,
indoor,
yeah. So
so
they could
the
have, I think,
indoor
up to 8
skydiving,
people.
right?
Eight.
So they
So
already had that relationship with defense or whatever.
yeah, so they've always had this relationship with defense. And as part of that, they started using the VR simulators with the skydiving to simulate, skydiving into various scenarios. And then it turned into, can we do more with VR? And again, they've sort of always struggled with this mix, I suppose, between what they would label enterprise, which is the defense, military, law enforcement stuff, and the consumer side of the business. So when they initially went down the VR path, they did it through the consumer side. So their centers are called Freak Centers. I'm not sure, people may be familiar with them. There's one in Bondi Junction, and I think one at Penrith maybe. So they went down the consumer side, and again, didn't really work. These centers, it's expensive to be in a Westfield. You sort of have your peak periods around school holidays and Christmases and whatnot, where you might do okay, but Wednesday night, middle of the week, sort of you're struggling to make money. But they had this capability. They'd built up this sort of VR sort of capability and development in house. And again, coming back to their relationships that they'd always had with defense, sort of recognized, well, there's this bit of a gap where it can be really hard to train military personnel and police personnel cost effectively, to make sure that they've got some level of training and qualifications or experience, I suppose, before going into these dangerous environments. And so that's where the idea for what's effectively Operator XR came from today. And again, go back to let's put it next to prophecy, because I don't want this conversation to seem like Operator XR is, an amazing business that everyone should go and buy. Because as you said, this is still a loss-making business. It's still a risky investment. It's very much a turnaround style investment, and you need a bit of a stomach for it.
Yeah, but I'm always here to throw some cold water on it, mate.
Yeah, I appreciate that. So their first contract was the Australian military, then it was the WA police force. But they pretty quickly realised Australia is a tiny market. The rest of the world is basically a tiny market. As much as this sucks, like the big market for this sort of product is the US. Like the US is a militarized country, basically. And so they established in the US organically, which again, risky, but I like it because a lot of companies will try to go through distributors, and whatever.
It's much better because what you get when you organically expand, if it works, is you get proof that you actually have a good product market fit.
But no, they went organic, and they poached a few sort of key sales reps from a competitor over there, mostly on having a good product and sort of selling them on the ability to sell Operator XR. But they started to get some really good traction, and I wrote about it in the latest Merriweather Capital monthly report, in the August report, that you sort of see the quarter on quarter recurring revenue chart from Operator XR. It's steadily growing. They're winning new work. And
actually, sort of on the quarterly results, I was keen to ask you. Look, I'm pretty basic when it comes to these little micros. I like to see them having their free cash flow or cash flow positive. And the reason that I wanted to talk about this one was because at least they're operating cash flow, and they do have investing cash flow. So they're not free cash flow positive. In the last 12 months, they were free cash flow negative, but their operating cash flow is now looking a lot better. 3 million for the full year, and then a strong final quarter at 1.3 million in operating cash flow. What do you think about the cash flow situation? Where do you reckon? You don't feel like, I don't want you to have to lock into any forecasts, but like, how are you thinking about, the path, or how are they talking about even the path to free cash flow positivity and then like ultimate sustainability?
It's a really good question. And it ties back to, again, a conversation we've already had about companies that can get cash or lumps of cash up front, and XRG benefits from that. So as an example, I'll talk about it now, but some of the excitement that's come into the stock recently is they won a large contract with a Texas state department, the largest one they've won, which is fantastic for them. And it's up front, it's a $4.3 million contract, which they will receive that $4.3 million in the coming quarters. So cash flow gets this big boost up front, but it goes back to that exact same risk that you were talking about before, is that, if you're not continually winning more contracts, and in particular, if management teams aren't keeping that working capital buffer in the balance sheet in the business, things can quickly, get quite ugly if growth slows down. So look, short term, call it next quarter or two, they've won some big contracts. I think cash flow will be quite strong. What's a lot harder for me to predict is, what does cash flow look like the back end of FY26? What does it look like FY27? And it's hard to say. They are building up. So there is ongoing license revenue. So they do have a tail of recurring revenue, but it's much smaller compared to the lump sums that come in. So
yeah,
until that really builds up, you're going to be buffeted around by big orders quarter to quarter. And it's part of the risk with the stock and the sentiment on the market, as I'm sure you're well aware.
That's very key to know. So I'm going to put this up for people on YouTube, but basically for the people just listening to the podcast, if I look at the Q4, the new sales total contract value, or I don't know how much of that they get up front, but that was like 9 million for the quarter, whereas the ARR, which is the annualized revenue, is like 4 million. So overall, it's not, it can still be it could potentially be quite volatile revenue, basically.
Yes, yes, and it's that,
Uh,
you see it quite a bit with business models like this, where it's the hardware software, because your hardware style revenue, that's where the lumpiness comes from. That's where you're winning orders, and you're delivering product to people.
they give you the
Um,
info, but it's like deferred revenue was up 61%, which is all well and nice, and that I'm great to see that demand. But at the same time, that means that they're sitting. There's like a lot of deferred obligation
you've got to deliver
essentially.
that product. Yeah,
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 exactly.
exactly.
So
One of the real risks to xReality Group, and I think it's, we hold a position, but for most people, why it would be an interesting idea, put on the watch list, and you can wait to see these things scale a little bit. It probably doesn't have, or definitely doesn't have, in my view, that buffer yet in the balance sheet. There's a bit of debt there. They're still sort of around that sort of free cash flow inflection. But what I would like to see, because I know they've got this big Texas contract, they've got a Department of Defense contract as well that will have some cash coming in. They'll generate some strong cash flow over the next couple of quarters, and I'd like to see that sort of hit the bank, not just go back out into product development, sales and marketing, and whatnot. Because it's always the temptation for businesses once that cash comes in, and you're, especially when you're growing and you can see the opportunities for growth, just to plow that back into reinvestment straight away. But knowing the working capital needs of growth, knowing the lumpiness of this, potentially of this business, the smart thing to do would just
and
to
another
let a
thing,
couple of $1,000,000 sit in that bank account and,
yeah.
and be that buffer for you.
And another thing to note for people playing along at home is if you go and look at the FY 2025 statement of cash flows, you definitely want to be taking in mind that repayment of lease liabilities, which is now under the financing
Yep.
activities, because at 840K, that's a fair chunk for this company. So
100%.
that's a pretty
Yep.
significant cost. So it's not quite there yet where the cash is actually going up overall, but except for when it has borrowings, more borrowings or less borrowings, but share issues, etc. as well. But essentially, yeah, look, I think it's really interesting. One, I love that. I think it's important to note. Look, there was director buying, and these are the heuristics that I like to see. They're director buying. You're seeing a bit of an operating cash flow inflection point, which can often precede a free cash flow inflection point. Um, but the director buying was at lower levels, I think 4 point something cents, and it's popped up. And it's popped up essentially, as I understand it, please correct me if I'm wrong, but that's actually to do with the contract announcements, right?
Yeah, 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 yeah,
Like, because
definitely.
in early August, it had a couple of announcements
Yeah, yeah.
there. And those are what we're now thinking, well, that could actually mean that it does get through, and that does drive it through to free cash flow positive, and that does mean they strengthen the balance sheet, which is, I guess, the bull case you're saying is that, like, best case
Sure.
scenario, they organically strengthen the balance sheet. That reduces the risk, and also the starts maybe heading towards profitability next stop. And they still have longer to go on profitability. Like, there's a loss of 3 point something million in the year. So
Yeah,
yeah, like,
yeah.
I still feels very high risk to me, and also sentiment a bit high
Very
after
much.
those
Still,
announcements.
still.
I could definitely see this coming, even if it does go on to do well. I could see it coming down just as people forget about it, for sure, because there's just been a couple of wins, and if it's not really strong next quarter, then it could easily come down.
Well,
But
look, and
on the
we
other
we
hand,
touched on it start of the show. Like there's a hot defense thematic at the minute, and like, that's not why I invest in this stock. But you've got to be, as investors, particularly micro cap investors, you've got to be mindful. And I know you do this all the time. Like try. Don't play into it, but be aware of the market, the sentiment, the heuristics. I know you talk about qualitative analysis all the time. All that stuff is so important.
xReality Group is worth watching, because if this is a sustained turnaround, if it is free cash flow positive next stop, if it is going to go to profitability, then I think very quickly after it hits profitability, then that's when the profitable defense company reality, it's even a bit
Yeah,
futuristic,
yeah,
like, and you can definitely say that organizations like police or defense or whatever would definitely be more warming towards the idea of doing this kind of thing. I'm sure they already do it to an extent, but I'm sure
mm,
that the general sentiment towards using virtual reality for training is only going to get warmer for a while. So you've got a bit of a tailwind there. And so, yeah, very interesting exposure there in microcap land. But like we are, yeah, like still got to say very, so but today's just one where we're talking about risky stocks. Okay. So
Yeah. And look, just to jump in quick, I know you were talking about software companies before, but it's important for any company. Like, do a bit of work on the product, get your head around the product and the product market fit. I've done a bit of work on their competitors, particularly over in the US, and I think they have a very good product. You've seen, potentially seen that in some of the contracts they've won. And again, something you touched on before is track your investment thesis. For something like xReality Group, the investment thesis is pretty simple, which is if the operator XR system is as good as what they say it is and sort of what I think it is, then they'll keep winning more police departments, more state departments, more Department of Defense contracts. So if you see a quarter where there's no contract wins or ARR, like obviously ARR goes backwards, that's
I
a big
definitely think
orange flag to
ARR
your
going
thesis.
backwards is worse than no wins, though, because I reckon you can always have a fallow quarter and it bounce back the next quarter.
Yeah. But whatever sort of threshold you set for yourself. But
yeah, track it. That's the point.
I was going to say it before, but I'll say it now. But I 100% agree. Like when a thesis is broken, leave. But the hard part is knowing when a thesis is broken, because very rarely do you get a black and white thesis breaker.
The one I was going to talk about today, which was more just, I guess, as a news thing, but also because I think it fits the theme. It's a little bit bigger. So this one's $146 million market cap. I own shares in this. It's called Ike GPS. The ticker is IKE. And essentially what it does is it has software and devices that are used for technicians and engineers to check on the health and understand the maintenance status of poles and wires and electricity systems, and also involved in fiber optic, anything that goes on the wires essentially. So both power and fiber optics. Now, part of the way that I invest, obviously, I have a great range of stocks from little loss-making small caps and all the way to very mature multi-billion-dollar companies. But if you really zoom out, part of the pattern that I've been looking for pretty consistently is companies that have, I guess, high customer retention. So, that can be a good sign of their product. It also often goes hand in hand with pricing power. And what is interesting about high customer retention is it can exist for a long time before a company is really testing its pricing power. Because if a company is growing via winning new customers, it probably prefers just not put its prices up too aggressively. So it's not really squeezing yet. And it's a good sign, because you want to keep it at that point where customers are incentivized to get onto your software. And the reason software is so interesting, enterprise software, is because you've got people using it, whether it's radiologists or field technicians that are out there doing the job of driving the car past these wires or down roads or whatever it might be. As long as they're a force of people using this software, there's a personal cost on them to change software. So they're not necessarily paying for the software, but they definitely don't want to have to change software. So that dynamic also allows for some excess profits, because the people that have a lot of influence in the customer's decision whether to stick with the software have a bias towards not doing it. Because if they change software so the company can make slightly bigger profits, they have to learn the new software, and it's annoying for them, and they get whatever the opposite of dopamine is each time they do a click and it doesn't get the desired result because they clicked the slightly wrong spot because the button's in a slightly different spot in the new software or whatever. So long route there for why I'm vaguely interested in something like IkeGPS, even though it doesn't hit my other quality kind of standards, like making a darn profit or anything. So what it is it's just another loss-making software company. It's a little bit bigger than basically, any of the other companies we talked about today, but it still hasn't. Yeah, it's still risky. So I'm not trying to say this is a great the next ASX darling. It's not there yet. Having said that, it is moving in the right direction. So I think the story that you probably want to understand here, if you want to understand why Ike GPS is like an interesting company to me anyway, is that its revenue now from sort of subscription style or transaction style revenue, the transaction came down. So there has a mixture of subscriptions and transaction style revenue. The transaction style revenue sort of had this huge boost in FY 2023 and has come down steadily since. But the subscription style revenue has been increasing steadily. There's also hardware revenue, but we're just going to put that aside because typically hardware revenue is like basically hardly even profitable compared to the software revenue. So I don't really mind if a company does have transaction revenue or subscription revenue. But the point is, if what they're presenting is to be believed, the overall revenue growth, which was like relatively modest, it looks smaller than the actual subscription revenue growth. So in Q1, they had subscription revenue of 4.1 million, which was up 28% on the prior corresponding period. Now, if we just focus on that, I'm not saying that like that's the perfect thing to focus on, but if we just focus on this subscription revenue, we've got the exit run rate of the annual platform subscription revenue is, and this is New Zealand dollars, by the way, is 16.6 million. That's up 29%. So by these very basic, I guess, measure of quality revenue, you've got good growth. Anything above 25%, I would argue, like that's good growth. You can really get operating leverage come through if you maintain that for a decent amount of time. And then on top of that, like we're just talking about this good growth in, I guess, like this what should be always growing subscription style revenue. So yeah, quite frankly, these guys are saying that they want to get to EBITDA break even by the end of, I think, FY 2026, which would imply that they would have a positive EBITDA by FY 2027. EBITDA, which is earnings before interest, taxation, depreciation, and amortization, is vaguely proxy for operating cash flow. And they don't have so much. Actually, I should check. I'm going to check in the last year how much it was, because that'll give us an idea of
capitalized development.
Yeah, exactly.
It was only $400,000 last year.
Yeah, thanks. That's what I was going to check, because I remembered that thinking that it wasn't too bad, so it wasn't something.
Always have to check with software companies.
Yeah, and look, I would even just look at the whole lot as well. And you've got some PPE as well that you do have to keep in mind with these guys, because there's that hardware element. So that does mean that there's a little bit of investing cash flow out there, but only like about $1 million. Then you got like $500,000, a bit less than $500,000 at least. So yeah, look, cash flow wise, it's definitely one where you're going to get, unfortunately, very similar to the other companies we mentioned. You're going to get again misled. Does get paid like big lump sums in front for like big contracts. It's not just getting billed once a month smoothly like that. They like do a win, they like get in a bunch of money, and then you see the same as exactly what we've been talking about with some of these with xReality Group, is this sort of like deferred like revenue, which is an even more extreme jump in the case of Ike GPS than xReality Group, mate. So I'm going to put this up on the screen, but for those playing at home, 3.8 million deferred revenue last year, 12.3 million this year. So humongous jump in referred revenue in the last financial year for Ike GPS. So that's why, even though they're like sort of close to break even on a cash flow basis, they still had to raise capital recently, which they did, and I participated in that. The thesis for this one for me is that with their subscription growth that they're getting at the moment, I want to see that continue to grow, but I need to see that grow to validate their product, essentially. And they say, if you listen to their AGM today, there was a bunch of like essentially positive commentary saying that, yeah, like there was a couple there, they named them actually. I'm going to get them up, but they said their biggest competition are Bentley System and Osmos. And so 3 different competitors, and the client base are all of these like utilities in the world, but also in America. I reckon that as a group, this industry of utilities is not going to all want to coalesce along with just one software vendor anyway. So there'll be some diversity, maybe 2 or 3. These guys, look, they said the exact quote from the AGM that I wrote down was, "We are winning more than they are." So, and also we also he also said, and we also hired some of their key people. Oh, does it save money for its customers initially when they start moving everyone onto it? Like it often does, because it makes them so much more efficient. And then if you get that customer, it's a lot harder to lose them, because the incremental gain moving from you to another software system that's similar is not very big. The thesis is basically free cash flow by FY 2027, or at least operating cash flow positive and a bit to positive would be the real bar. If they just definitely don't get that by FY 2027, then definitely I have to say that that's not on thesis at that point. But yeah, the upside I'm holding, just because, well, if it does cross that inflection point, it'll start getting a lot more attention.
A couple of things from me, just more heuristically, but it's a dual listing. Like I think this is originally a New Zealand company,
Yeah.
and there can be good opportunities there because it means the ASX listing can be quite illiquid. And again, as you know, being in the microcap space, the illiquidity means people will often just not pay attention or not look. So
There's this sort of mechanism where if a company is good or doing well, then the more people that are looking at it, just the higher the multiple tends to be. And also, um, the sizes means that as something gets bigger, more people look at it. So there are an awful lot of funds that might have $100 million under management, which means to deploy like 1% of their fund, they need $1 million of liquidity. Now, if there's all of these stocks where the guys would have to be like accumulating it for 4 months to get, or 5 months, who knows how long to get $1 million of liquidity, those fund managers don't tend to do it. And it's not because they shouldn't and not because they couldn't, and not like if they should. A fund manager that has 100 million should have small holdings in a bunch of little stuff they think's good. But the problem is, in their world, it's not a good use of their time, because what they care about, at least financially, is beating their index, beating their benchmark. And this tiny stock's definitely not in their index, so it doesn't matter from that perspective. And then the other side of it is that, they need to be able to honor liquidity in their fund, so they can't have too much in illiquid stuff. If someone wants to withdraw, they need to be able to honor that. And then they're also thinking, like, even if I nail this one and it doubles, it's not going to make any difference to me, because I won't have been able to put enough in it. So that's why they then just don't look at the tiny ones or smaller ones or illiquid ones. And then that means that, like, something can actually have quite a good track record of developing its business well, and still not that many people are looking at it, or funds tend to be sometimes can be a bit late to something if it's illiquid.
Yeah, no, 100%. I mean, and it's a lot of what I do with Meriwether Capital every day. Look at companies, and I talk to peers who run larger funds or a bit more money, and it's amazing how often I hear they'll know about a business or have heard of a business but can't really look at it properly because there's no liquidity there. But yeah, so there was that. I think you made a really good point before. A fantastic point on. I think a lot of times when people want to look at software companies, the first instinct is to look at the growth rate. Now, Ike GPS actually has really good growth regardless, but I agree with the first thing you pointed out, which was, to me, it's that churn rate, that retention rate. I think is much more important than growth. You'd rather a business that's growing 10% but 99% retention and maybe some net positive net retention versus one that's 20% growth but churns 10% of their customer base every year. You've got to run to stand still, sort of thing. So I don't know Ike GPS too well. I've only ever had it come up on Ausbiz I think once before, but I sort of top level point of view came to all the same conclusions you did. I did note the same thing though with the deferred revenue, and just one thing just to further flesh this out, and not a positive or negative, just sort of more just for the information for viewers and listeners. But that big jump in deferred revenue that you were pointing out before was actually non-current deferred revenue, meaning that they're not expecting to recognize that as revenue for more than a year because there's a non-current asset on the balance sheet. So clearly they've had a major customer, probably big Florida power company or something like that, pay them from the looks of it, maybe a 3 or 4 year contract in advance, which
and I'm not sure
can
if
be
it's
a very good thing. You said this before,
sure.
like we were talking about the negatives of this, but if you get a customer that's willing to pay you, many years in advance, that gives you cash that you can go and spend. to grow the rest of your business. So I really don't want that to come off as a negative, just more for information.
The other thing is you can have customers reduce their spend if they finish a big project, like finish a big rollout. Then they might reduce their number of seats on it. So it's not always land and expand. It can go up and down. That's why we have seen like reductions in subscription revenue, in transaction-based revenue in the past, when they've sort of de-emphasizing that as well. But essentially, we just essentially do need to see them continue to win customers. But at the same time, they're saying in their guidance that they're going to get 35% or greater growth in platform subscription revenue.
That's really strong growth.
Look, maybe it's just complete fantasy stuff, but I mean, if it's not fantasy stuff, that is evidence of a real, what I would argue is like it's clicking, in terms of there's a product market fit. And look, there's some stuff I don't like about it at all. Like to me, they run at too much of a loss. I really would prefer, like, for me, it's just a no-brainer to try and run this kind of business at a very small profit. And look, their quarterly update doesn't even talk about profit at all. And it's just not a focus for them. They had a huge net loss because there was like an impairment of previous spend. So development spend, I think it was, remember. Its financials aren't there. I can't love it, and I couldn't bring myself to get too convinced about it. But it also just has enough heuristics that I'm like, well, if it does this 35% growth in subscription revenue, at a certain point, people are going to start being like, this is a good business. It's a good one to follow. Look, it works out sometimes. RPM Global is a great example of one that, had made that transition from loss making. When I first recommended it years and years ago, it was certainly loss making, and make that transition to profitability. Suddenly it re-rates on that, quite frankly, and now it's got a takeover offer at a much higher price because it's hugely de-risked.
Ike GPS, to your point, you're getting that 35% revenue growth. Right now, they're still spending quite heavily behind that, and there's probably a massive opportunity in the US if they've got a good product and they're having good conversations with customers. But realistically, I think what the thesis would be here is not only getting to that profitability, but maybe there'll be a half where, when you're punching numbers in the spreadsheet, you'll see 35% revenue growth, but operating costs grew at 10. Now, all of a sudden, you start to model out that sort of operating leverage, and that jaws start to open up. And I mean, one of the things that constantly confounds me is some of the valuations paid for ASX software, where, to be honest, growth rates aren't that great.
Fountain of fortune. I love I was standing gazing at this enormous bogon moth, overlooking this beautiful lake. And I was just taking a deep breath, and I just had a swim in the lake. It was cold. It hit me hard. I took a deep breath, and I was just having this almost transcendent moment. And I was just thinking, it's I'm so grateful that I've just been able to spend my life buying little software companies before fund managers know about it, or before they can buy it or whatever, and then just holding them, and then years later selling them for way higher. And it's just a clear transfer of wealth from money guys to myself. They have enough. And I hope that this dynamic keeps working for another 10 years or something, because, isn't it amazing? I wish someone could have just whispered in my ear 10 years ago, just keep doing this thing. 17 of them exist. Something like that. It's oh yeah, just buy them before the other guys. That's right. Yeah. So I hope it keeps working, but you have to understand a lot of, I guess, what I'm talking about when I'm talking about IkeGPS, it does, partially rely on that, because, when you're talking about tech stocks and software stocks, I guess in a way it is actually partially more about a little bit you could call it greater fool in investing. I don't know if that's really accurate.
Sort
but
of.
Some people would think of it that way.
I want to jump in and I like that we're putting cold water on all of this, but we spoke about prophecy at the start of the show as the cautionary tale. I mean, those guys got to 25 mil ARR, which is getting to that sort of number where, at that point you usually start to see a bit of scale over a cost base and profitability emerge. And what happened was the product, probably wasn't as good as what I thought. You get some customer churn, and all of a sudden it's completely blown up, that thesis. So there's risk to all this, but I suppose to your point is that if this thesis plays out as expected, that's the light at the end of the tunnel. Well, not even light at the end of the tunnel, you know what I mean?
Yeah.
But that's the end goal for this sort of investment. It will be bought by those same fund managers. Look, I don't know IkeGPS super well, but those examples you gave before, and hindsight's always easy, I know, but they're great businesses, and I've always had this view that it's hard to know where a business will go, because great managers and great businesses will go in directions that you wouldn't expect, and they'll find ways to venture out into new modules, new geographies, new customers. That's why with micro caps I try not to forecast. It's so hard for these businesses to forecast out 3, 5, 10 years, and you're sort of, in a lot of ways, you're backing the management, the businesses, to sort of execute on a longer term vision, and understanding that if they're good enough, they'll roll with the punches. They'll adapt to the environment. They'll adapt to the changes, and wait and see. But xReality Group could be an example of that. I mean, started off life as a skydiving mob, and potentially is now doing virtual reality, defense training. It's very, very different. But that's what sometimes companies can do. Not all of them, obviously. But I think IkeGPS, it's got a lot of those heuristics.
Yeah, exactly. Anyway, so that's why I own it, full disclosure. Look, mate, thank you. It's been such a great conversation. We've gone on long. I'll have to edit this down.
Yeah, I know.
No, it'll be good. We'll have heaps of great stuff. And I'm so lucky to be able to draw on my friends like yourself to come on here and talk about. We have some niche knowledge in this world we've been playing in for a decade or more. And so, yeah, it's happy to also for myself, just to ground myself in the process that I love, but also not to lose track of the way. It's so easy to slip, I guess. And even though we talk about our lessons, it's how well can you apply them over time? So, look, with that, everyone, I, of course, have to do the whole disclaimer thing. Luke, you own XRG. I own a few of the quality stocks we use as examples in this: RPM Global, Objective Corp, Pro Medicus. I also own Ike GPS, which was the one I brought to the show. We both talked about Prophecy International, which we don't love, but we don't own. And then, of course, none of this is definitely not personal product advice. We don't know anything about you or your circumstances. Most likely, if in doubt, small cap investing is not for you. And before you make any decision about whether to acquire a certain product, you should definitely obtain and read the relevant product disclosure. Again, nothing we said should be the basis of any kind of investment decision. Having said that, if you are a fellow small cap follower, an investor, we love the comments. Thanks so much, Luke. You've done really well by me and Chloe with your investing in the fund, and also I love reading your letters anyway. So definitely, I think the letters are a must read for anybody playing in this space. So thanks a lot for being here.
Thanks, mate. No, appreciate it. Anytime. You know me. Always happy to come on and chat small caps.
Cool. Thanks for listening, everyone, and have a great evening, afternoon, or day wherever you are.